Welcome to the Chesalbridge Capital Market Observations Call for Tuesday, June 20th. I'm your host, Eric Jefferson. A lot to discuss today. We're going to start by recapping some of the major events, reports from last week. Got inflation reading, heard from Fed Chairman Powell as well. We'll do a quick recap of equity and bond markets, then discuss our outlook going forward. Before we get started, though, I have a few quick words from our legal team, and with that, we can go ahead, dive right in. As I mentioned, I want to start with some of the macro data from last week. On the inflation front, got some good news. First and foremost, that CPI, or the measure of inflation, continues to trend lower. Granted, a majority of that progress is a function of lower energy prices. Bad news, although inflation is falling, not falling at a pace nearly as quickly as many would like. And that is largely due in part to the stickier components or the core inflation metrics not slowing, again, nearly to the extent that many would like. One interesting narrative that's really developed here regarding inflation as sort of the catalyst or the reason we'll avoid a recession. And as we think about what has brought inflation lower, that is lower energy prices that is sold off due to recessionary fears. In turn, that has brought inflation down. If we do, in fact, avoid a recession, if the worst is behind us, in all likelihood, you would anticipate energy prices to trend higher, which in turn bring inflation back up. I think that puts additional emphasis on that core inflation, why it makes it so important if we truly are going to head back down to those targets that have been outlined. Last week, in response to inflation, we heard from Fed Chairman Powell. They elected to pause or to skip a June rate hike. However, in their dot plots, which is how they forecast where they anticipate rates being in the future, they suggested 2 additional 25 basis point hikes. That somewhat caught the market off guard. Granted, the expectation for a June pause very much baked in. And granted, that behavior has drawn some criticism, particularly when you consider the fact that based on their forecasts for future GDP, neither Powell nor any of his peers anticipate a recession throughout the balance of this year, next year, or even into 2025. And so that really begs the question, if the economy is so strong, we're not worried about a recession, yet inflation is still so unacceptably high, why wouldn't you take action? Why wouldn't you continue to raise? As a result, you've had many in the industry start to speculate, is Powell truly serious about rates going higher, or is this simply a way to possibly buy some more time, hope for more progress on inflation? Because the concern, obviously, if they raise too far too fast, there's already been a historic rate rise going back or beginning over 12 months ago. The concern is where these things take time for their impact to be felt. You don't want to do too much and then restrict the economy, send it into recession unnecessarily. Powell will testify to Congress this week. Will certainly be very interesting to hear what he has to say. That will likely give him an opportunity to go into a little more detail. Speaking of the economy, obviously its backbone is the U.S. consumer. And got a recent reading with respect to retail sales, which aggregates how much consumers go out and spend. Good news, that came in above expectations. Once again, encouraging sign, speaks to the resiliency of the U.S. consumer and the economy as a whole. One possible area of not concern, but certainly something worth keeping a close eye on, is that on a real or an inflation-adjusted basis, spending was down 3.5% to 4%. So again, good to see that people are going out, spending money, although if sales are up and real sales are down, that translates to folks buying fewer goods as a function of higher prices. One example, if consumers typically go out, buy 2 pounds of steak, and that costs $12, if it now costs $20, you can go out, you can spend $15, buy 1.5 pounds of steak. You're spending more than you did before, but you're getting less. Really, that's what we're seeing play out as a function of higher rates. And again, why Powell and company are so focused on taming inflation, because if left unchecked, can meaningfully erode purchasing power as well as wealth. Now, as we examine the consumer through another lens, continue to see initial unemployment claims slightly tick higher. That suggests the labor market showing some initial signs of softening, but with more open jobs than available workers, hard to see a meaningful jump in unemployment. Granted, has ticked higher from historic lows, currently at 3.7%, still well below what historically you would see in a recessionary environment. One interesting twist, though, something to keep a close eye on as we think about the consumer. This is something we've received a few questions on as of late, and that is around student loans. Repayments are set to begin in late August. During the pandemic, there was a program that put a halt for most borrowers, deferring payments as well as suspending any interest accruals. That policy, if not extended, is set to expire end of this month on June 30th. We then see payments resume within 60 days. There's a second executive action on the table that was forgiving anywhere from 10 to 20,000 of student loans. That is currently tied up with the Supreme Court, but focusing on the first issue, if that is not addressed, we will start to see those payments resume here in the next quarter or so. That will likely have a negative impact on the consumer, as well as some of those more discretionary sectors. It goes back to the common principle: if there are fewer dollars left in the checking account at the end of the month, fewer available dollars to go out, spend on things like travel or dining out, etc. As we shift our attention to markets, despite all of the uncertainty, S&P 500 index continues to march higher. As we've talked about, that has very narrow leadership. Really, it's about 7 or 8 stocks in the S&P that continue to absolutely skyrocket. They're dragging the rest of the index up overall. As a result, we see the market now being extremely concentrated. To put this in perspective, 40% of the stocks in the S&P 500 over the last 12 months are still negative. Granted, the index over that time period up over 20%. Again, that is a function of the largest 7 technology stocks now making up almost a quarter of the index. Those stocks on average up nearly 60%. So if that's something, you had a concentrated portfolio in technology stocks, kudos to you. You have done incredibly well. For folks that take more of a diversified approach, obviously this year has been somewhat frustrating when we think about what ultimately the market has rewarded. The better question, though, where do we go from here? And when we think about what's ultimately required for a sustained rally in stocks, it's profits or earnings, it's liquidity, and it's sentiment, which is typically a function of valuations. Right now, profits or earning projections are fairly flat. Liquidity is diminishing when we think about the Fed raising rates. That attracts more money out of a checking account into savings vehicles. And then when we think about sentiment and valuations, those are certainly very pricey at the moment. Obviously, sentiment can have short-term deviations from valuations, but over longer periods of time, the more expensive a stock is, fewer folks are typically willing to jump in and buy it. All of those will evolve as we get a little further into the cycle here, but we consider the very wide range of possible outcomes. I think it's incredibly difficult to truly be overweight risk here. Not that the market can't continue to bleed higher, but a lot of uncertainty out there that at this point makes being fully invested or certainly above a beta of 1 very difficult to do. Now, the one good news for folks that do take more of a strategic approach, that do remain fully invested, if you are in a moderate allocation and incorporate bonds for some portion of your overall mix, good news there. Whether or not we get another 25 basis point rate hike or possibly even 2, I do believe Fed is very towards or very far towards the end of their hiking campaign, at least for this cycle. And as a result, do believe bonds now very not only reasonably valued, but attractive from a total return standpoint. If anything, they likely, if we do see a material slowdown, we'll see duration start to once again be a friend. But even in the near term, assuming rates stay flat or even just modestly move higher, investors are now compensated via a very attractive coupon or degree of interest that are paid. That duration, that measure of interest rate sensitivity, something that meaningfully worked against you last year, but now as the pendulum has swung in the other direction, would say now works in your favor. So a lot that we covered there. As always, happy to discuss in more detail. And if you don't connect, have a great rest of the week. Take care.